Hello Proponomics people, and welcome to the supplement from the 2nd of June 2024. And this week I decided to call it the damp squib, with a question mark, because everything so far about this election campaign and a few other things that are going on at the moment seems a bit like a damp squib. Not least because Rishi got himself so wet when he announced the election just a couple of weeks ago. But anyway, it's not all about politics today by any stretch. It's a bit less political than last week. I know that I went on for a bit too long, probably, on the supposedly independent PRS report that was commissioned by Labour, but a little bit more on that later. So, as you'll know, I like to start with a quote, and this week's was, "A situation or event which is much less impressive than expected," and that is the Oxford English Dictionary definition of the damp squib. So not a quote so much as a definition this week. Before we get started, I want to say a little bit about our property business workshop that's upcoming, still taking bookings. Despite it being on election day, it's definitely the most important thing you could be doing on the 4th of July. Make sure to get your postal votes in, folks. There are still some tickets available with the early bird discount. And this time, Rod and I are going to be taking on the fundamentals of property investment, risk mitigation and control, relevant investment metrics, differing secured debt arrangements and loan structures, and scaling your property portfolio or business. Why, when and how. Thursday the 4th of July, yes, we did organise it before he called the election. Central London location in Blackfriars. Early bird tickets available, as I said, and thanks very much to the bookers who do book early. They do get rewarded with a discount. There are still tickets available at bit.ly/PBWTHREE. So, as I mentioned, back to the supplement. Thanks for listening to that bit. This week it was a definition rather than a quote because of that damp squib and the pouring rain, and just how both of the campaigns have started, really. And also probably the pre-election property market, because I was looking forward to some pre-election deals, but a comparatively short period of time in order to do them now. And all it's done really is look like it might start to knock the train off the tracks, although there's no evidence of that just yet, and I'll say a little bit more on that later. But you can have between 3 and 12 weeks to call an election in the UK. Obviously the PM opted for 6, so on the shorter end, so it gives us a bit less of a window. Let's see how it plays out at the moment, because it seems that a lot of the bits and bobs that have been said over the years about pre-election and post-election markets might not be grounded in fact, and there's been some interesting articles I've shared on my LinkedIn about that over the course of the last week, if you want to go and check it out. So, as I said last week, I didn't get much in terms of traction and comments. I think I stunned everybody into too much silence. These little pieces I tend to do once a year probably, where I have the time, where there's 10,000 words or more in it. A near dissertation length effort last week, and I didn't get tons and tons of traction, and I imagine I probably went a bit too far, even for people who keenly tune in on a weekly basis, to go all the way through that, because it is very long. So apologies for that. That's my indulgence. I'll try and suppress that for another few months at least, unless there's something I feel that really needs looking into in that level of detail again. I'm pleased that I went into that level of detail about that PRS independent report commissioned by Labour. I can't keep resisting those little digs at the independent word, because it is a bit of a laugh. But anyway, back to a more workable format this week. A little bit on the market, property market itself, bit of macro, and then a deeper dive into the mountain that the next government's going to need to climb. So, Chris Watkin was back this week. We missed his stats last week, with a recycled headline, the best property market fortnight since May 2022. That's the second best fortnight in the past month, which is obviously promising because it means it's surpassed the last best fortnight, which was recent. So, May 2024 was obviously a pretty good month in the property market. The sale agreed price is moderated to £348 a foot. That's 5.1% higher than the January sale agreed figure. So look out for that ONS index when those settle and that all kicks in. So, if we're still talking 120 days to completion on deals agreed in May, you're talking June, July, August, September, and then they've got to hit the land reg. So we're talking, that's got to hit the ONS figures. So we're talking about seeing those around about the end of the year. Will we see that market around about 5% up? That was my prediction for this year. So we will see. But obviously these things work on a lagging basis. And it's not about whether predictions are right or wrong for the calendar year. It's about, can we talk about what's going on in the market now and make good decisions based on what's happening now? But time will tell. The gross sales are still 7.8% ahead of the 17 to 19 pre-pandemic market, so definitely healthy volume. And the net sales are 5.4% higher than that market. So there's obviously a few more fall-throughs than there were on the average market of 2017 to 2019, but of course there was more stability back then, and any volatility does give a reason for there to be more fall throughs, but they're not doing badly. We were at one point where we were nearly 50% of deals agreed were falling through. We're back down to between 20 and 25% of deals, so 1 in 4 to 1 in 5 falling through at the moment. Much more healthy. Still far, far too high. And as we know, I think that the UK market is being reviewed by the RICS, apart from anything else, in a way that they could potentially help transactions stay together a little better. The pre-2008 Scotland system, often lauded as one of the best. You make an offer and it's binding. You send the missives, aka exchange on the property. Although that system has changed since 2008 because too many deals fell apart in a crisis moment, and that's sort of flexed to the law. So now you have offer letters in Scotland instead of getting to exchange. But you rarely see people pull out. But let's see those ONS figures pay out in December, January, and I'm sure I'll be talking about whether I was right or wrong. Probably talking louder if I was right, just like all forecasters. Although it's not like all forecasters, because most of them just walk away from a poor quality forecast and pretend they didn't do it, which I never do. So we'll see at the end of the year. But there's a lot of correlation between that pound per square foot, and that's why I put it in the supplement now every week, and what happens in the ONS 5 or 6 months down the line. So it does need to be borne in mind. Very, very high correlation. Just want to say an ongoing thanks to Chris for his commitment to keep us informed in the sector in real time, and then move on to the macro. So it was a pretty scrappy week, half term for many. We had a very surprising distributive trades print of +8, which was way ahead of consensus for May. But April was such a disappointing print. That was -44. This was just written off as a bit of that levelling out, and April washing into May quite literally. This damp squib was blamed on the rain. 200% more rain in February than average. 155% more rain in March and April than average. Not ideal for retail shoppers. Remember, still most of that shopping still goes on offline, not online. So, Nationwide also released their house price index, printing a +0.4 for the month, taking them to +1.3 for the last 12 months. Zoopla also delivered theirs, although that's their April figure, not their May figure. They see prices down 0.1% on the year. So that's the last 12 months rather than the calendar year, to be clear. But as I say, that was April. So month on month, there's no change in the Zoopla index from March to April, according to them. But they did go into some interesting detail about various cities and how they performed. So I shared the image for this week's supplement because I thought it was interesting. Belfast was right at the top, but I think we can write that off as some kind of Brexit effect. We're not necessarily privy to that on the mainland. I think we know from murmurings of immigration, even for those of us who aren't in Northern Ireland or in the Republic, know that something has definitely been going on, and Belfast is in much more demand, and Northern Ireland in general, due to access to the EU, apart from anything else. So how that's all going to play out, we'll find out over the coming months and years, won't we? Ipswich was at the other end of the scale, east rather than southeast. Not an expensive place as a rule, nearly smack on the average, so higher prices, to be lame, isn't necessarily the way forward here. Coventry also made it into the losers over the past 12 months. That's a city I've got slotted in for major capital growth over the next decade. But in Coventry, we're talking 1% down, and there's always a bit of noise in statistics. And only a fool doesn't recognise that the market has been flat over the past 12, or maybe down over the first 8 and then up in the past 4, if we're talking until April 2024. But in Ipswich, the number was 3% down. We have to be careful with data and not take it too much to heart or draw too many conclusions based on 1 month's reporting or similar from one source. I find myself saying that every week these days. You could also look at the chart and decide that the best tactic is to invest in areas beginning with a B, because the first 4 in order are Belfast, Burnley, Bolton and Blackburn. Manchester's also done well, and I'm sure that's got a non-zero impact on several of those. Zoopla also cut through the noise though, and led with the fact that we have the highest number of homes for sale that we've had for 8 years. Sales are up, but not as much as new supply, as evidenced in Watkins' figures. They also mentioned the election, and here's another damp squib, certainly in Richard Donnell of Zoopla's view. They expect a stall in sales agreed, but point to the fact that escalating rents are forcing action from first-time buyers. I'd also expect it to be forcing action from Bank of Mum and Dad too, because there's so much equity in so much of the UK's property stock. The conclusion from Zoopla, though, is that this election is likely one with less impact, mostly because of their lack of true policy divide between the two parties. They have revised down their 1.1 million completions slightly for 2024, simply because of the timing of this election, because the housing market was really gearing up for the early summer. Richard still sees house price inflation to be flat over 2024 as a whole, and I still respectfully disagree with him, as I've been saying. Anyway, there's plenty in there on the house price indices and some good discussion in the reports. Nationwide uses a different methodology to show that they don't think elections have much of an impact either, and their data does seem to support that view, although it doesn't really get into the granular detail enough to draw a necessary conclusion. The narrative from them, though, is the show goes on. Last week of the month also always sees the Bank of England Money and Credit Report published, which I usually zero in on, and the press normally concentrate on the number of mortgage approvals. People who listen and watch regularly and read regularly of the supplement will know I like to go a bit deeper. There was very little change in the number of mortgage approvals. We were down 200 on the month. That's worse than being up 200, but it's only psychological, really. The numbers stayed above that magic 60,000, and whilst we're chasing 65 to 70,000 for a more voluminous market, that was the healthy market number pre-pandemic anyway, we're okay with 61,100. Remortgages decreased from 29,900 to 33,500, which is a shame, of course. But the rates ticked up again in April, if you recall, after starting the year at a really generous low. Given what I thought was obvious at the time, it was very low, which now seems to be the conventional wisdom, finally, in the marketplace, higher rates for longer and more persistent inflation. But will that be the case? We'll find out. Remortgage numbers also only capture those remortgaging with different lenders, so they're not the Bible by any means when we look at things like product transfers and refixes and all the rest of it. 11.7 billion went into ISAs, the most since records began in April 99. So obviously this was the report for April, published at the end of May. So households had a very healthy net flow of money again, but the 8.4 billion that it was, which is the healthiest number since September 2022, went into savings and then some. Lending also dropped significantly from last month's report, but as I always say, 1 month is 1 month, so I'm not going to conclude too much from that. Net mortgage lending actually grew last month for the first month since October 2022. Let us imagine what happened there, if you'll pardon my pun. Outstanding mortgage rate average is now 3.57% in April, and newly drawn mortgages at 4.74% on average. So there's still a 33% cost gap between those two, although with rates likely to come down, that entire 33% isn't most likely to have to be absorbed in its entirety. 4.74 is 33% more expensive than 3.57, just to clarify. Also remember, most people pay repayment, the vast majority, and so that 33% looks more like 16% or so on the average LTV of 42% or thereabouts, in terms of how much it increases monthly repayments as it nudges forward month on month. Nationwide did run another article this week about debt repayments for households jumping up significantly according to their transaction data, which they aggregate and share. Of course, what they wouldn't know from that data is what percentage of that is capital repayment and what percentage is servicing interest, but it is on the rise, and they decided to lead with the headline, "Spike in debt repayments as costs continue to hit household budgets." That leaves only one item left on the macro menu, the bonds and swaps, of course. We had a short week because of the second May bank holiday, and so on Tuesday's open we opened at 4.182. Had a bit of a climb until the ECB pretty much announced they were cutting next meeting, even in the face of a higher inflation print. But remember, that might be very sensible. They're looking 6 to 12 months ahead before having any impact of a cut. There's also a currency decoupling that's going to play out here as the old follow the Fed narrative bites the dust in the following months and years, in my view. So let me tell you what I think is potentially going to go on there. I think that the US are going to have to hold their rates higher for longer. The ECB are clearly making cutting noises already, and I think the Bank of England is going to sit somewhere in the middle. So this idea that we have to wait for the Federal Reserve to take action first, if the Fed do cut and did get involved in what would have to be considered to be a political cut, that would be a surprise. But nothing's impossible with politics involved, of course, and they know when their election is, early November, always the same. So there was a late rally to get us to 4.3 on the 5-year, but we got closed at 4.211. I still think that's too high. I still think it's overly influenced by the USA, but let's see if the markets do swallow that pill. It could take a long time for the markets to swallow a decoupling view, where basically we realise what's been true all along. The central banks are independent of each other, and each major nation is facing different currency and monetary policy pressures that they need to respond to in different ways. The Thursday close was 4.238 and the 5-year swap closed at 4.159, still preserving about 8 basis points or so of discount. The higher the rate is, the higher that discount might creep, as long as major volatility is not back at any point in the near future. Fingers crossed. That concludes the macro report, but I do want to go into some more detail about inflation and this central bank divergence in policy over the coming period, because it's happening apart from anything else. I then want to get into the problems facing the new government and what they mean for property. So, slightly longer word on this inflation situation. I pointed to the fact in the past that the UK money supply swelled by about 22 to 23% as controlled by the Bank of England during the pandemic. That number is so suspiciously close to the actual rate of inflation, CPI, that I find it baffling that some make out that the money supply isn't really related to inflation. But they do, some of them. The US number is more like 37%, and their inflation hasn't even matched ours over the same time period. My contention is that money will find a home and continue to chase prices upwards across the pond. We've dealt with ours momentarily and absorbed it. That's the big difference. We still have the lag effect, rents racing forward because they started to increase late versus prices, wages also racing forward for the same reason. The EC figure for growth in money supply, 21.8% since January 2020, looks very similar to the UK figure, just a tiny shade lower. And their economy as a whole has higher unemployment to deal with and a lower rate of interest to start with. But a prudent approach still stamped by the German influence, of course, with regard to deficits, and they are overall adopting a much more sensible approach to tightening than in the UK, in that they are not currently selling their bonds into the secondary market. We are, and it is scheduled to cost the taxpayer many billions. How many is constantly underestimated while yields stay high. So I know this is a bit of a technical point, but this is what we're doing in terms of quantitative tightening. We're not just not renewing our bonds, but instead we're actually ultimately selling some of those bonds into the secondary market. And we have committed the worst sin here. We bought high and we're selling low, rather than letting those bonds expire, because we're so keen suddenly to get out of unwind our quantitative easing position. I do not see the logic in doing it and costing the Treasury and therefore the taxpayer 50, 60, 70 billion quid and potentially more than that. I think we need to revise this policy as soon as possible, and there's a fair few people in Parliament or in the Lords who do try to hold the bank to account on this. Unfortunately, these debates tend to be attended by about 15 people, half of which are asleep, it seems, and there doesn't really seem to be anything achieved, but there are a few trying to hold the Bank of England accountable for this. I can't make sense of this decision given the quantum of the cost to the UK taxpayer. I really, really can't. But anyway, that's what we're doing, so we deal with it at the moment. You can almost guarantee the yields will stay high until we've done most of the tightening we want to do, and then they'll start to fall sustainably. That's, of course, Murphy's Law in action there. But ECB inflation over their time period, of which money supply has gone up nearly 22%, is 21%. Another incredible coincidence, but that very rough measure suggests that their worst is definitely over, whereas the US is far from out of the woods, in my opinion. Still got almost the same amount of inflation to go again before they match that money supply, unless they're going to find a way of tightening it, which they can't because they're still busy printing loads and loads of money because they run a huge, huge deficit in the US, and in an election year, that's not being cut. And with the two candidates there are who are going, one of which is going to be president, neither are running on the back of a significant deficit, cutting the deficit apart from anything else, because cutting tax like Trump did in his first term ultimately simply increased the deficit massively. So very non-Republican, but that's the way things are at the moment in the States, so there we go. So I think the ECB will try and cut rates relatively slowly in an orderly fashion, and it's quite clear they're going first. That's going to strengthen sterling against the euro. The UK is highly likely to be ready for a cut soon, with some recent disinflationary evidence, a higher savings rate and the drag of debt. All this brings consumption down and makes the worry of the one dove on the Monetary Policy Committee, that's the external member, Dr. Swati Dhingra, she worries that consumption's fallen too much. It's a bigger priority for her than it is for the rest of the committee. Aggregate UK spending is down 10% or so from before the pandemic, and 8% down on 1 year ago. people have simply started spending less because they've got less to spend, and real household disposable income, much as I love the metric, is being disposed of on higher rents above inflation, higher mortgage payments well above inflation, and more saving, as already stated, because of fears that situations could deteriorate. And also because saving is simply much more attractive than it was pre-pandemic, because you can actually get a return. And right now, today, that return is real, i.e. it's above inflation. So, remember, consumption represents 2/3 of GDP. So does that leave you wondering exactly how GDP has increased at all? The answer is almost singularly a massive increase in government spending, of course pandemic sponsored. We have almost guaranteed growth if we can keep up with the ambitious and frankly impossible plans for real-term spending growth on the NHS alone, before I even start on welfare. I came across a great chart this week on the King's Fund website, that's an independent charity, about this. In real terms, the annual increase on healthcare is shown by Parliament and colour of government. So let me give you the tale of the tape. Since 1955-56, annual NHS spending has increased by 3.6% a year in real terms. Conservatives varied from 5.3% in their government of the early 70s down to 2.6% in the 80s and 90s. The coalition government of 2010 to 15, which has to belong 90% to the Conservatives, increased spending by only 1.1% a year in real terms, but it still did increase in real terms. For this Parliament, it's 2.8%, but this is an average, and the extra monies put in during the pandemic will have padded that percentage somewhat, of course. Labour's most notable contribution, as a contrast, is a 5.5% real terms annual increase in the years 1997 to 2010. Their other administrations in that time period tended to stick to a low threes or so. Still not bad, you would think. So now in one fell swoop, I'm going to tell you why I'd never get elected, and also why we have a problem coming at some point, or just simply bigger and bigger tax burdens. This isn't affordable. It can't go on at anything like this rate. It might be the chickens from the 2010 to 15 period are coming home to roost, but it might also be the pandemic has given the NHS a kicking, or that the dependencies in the system, in terms of the sick and the elderly, alongside the expansion in other treatments, new drugs and the likes, have meant that 2.5% or similar simply has not been enough of an increase in real terms. And that's not forecast to change at all. So can you see the inevitable problem here? Growth is expected to run about 1.6 to 1.7% in real terms going forward. A major departure upwards from this would be quite a shock, or in reality, the result of a significant leap forward in productivity. 2.5% per year in real terms increasing, in terms of what we hear about the state of the NHS today as reported, doesn't look like enough. Money doesn't solve the problem alone, but 5.5% annualised real growth definitely made a huge difference between 97 and 2010. So we can't afford to sustain even a level of growth that doesn't lead to great outcomes at the moment. The ultimate ends here are, number one, wholesale collapse of the NHS, perhaps over decades, arguably already started. Number two, fantastic productivity improvements, which means we can do more with less money, yet to emerge. Number three, draconian rules, meaning that certain people are excluded for various reasons and situations. Sounds a bit dystopian, but I'll let you conjure up your own images there. Number four, funds are levied over and above tax, as they already are for dental and prescription services for some and many. Missed GP appointments, costs or fines, for example, would be one way of doing it, and there'll be many more. We currently raise about 1% of the NHS budget based on prescription costs, apart from anything else, so that's how much we contribute at the front line. Is it even worth writing number five? A sensible conversation about how to grow the health service sustainably over the coming 10, 20 and 50 year periods. No breath being held. No one wants to smell the coffee, the politicians would tell you. Personally, I find it pretty insulting given that we don't have a massive pretending we don't have a massive elephant in the room. I wonder how others feel about that. I can't resist a little extra indulgence either. I might consider 6. With the rise of literature and media around ultra-processed foods, do we need a tax based around the cost of this in our NHS to combat type 2 diabetes, for example, which is typically individually driven? Sugar tax worked pretty well, to be honest, even though it wasn't considered very conservative. Tax the bad stuff, subsidise the good stuff. That's pretty radical, and it isn't about tax revenue, it's about bringing the cost of treating type 2 diabetes and related elements down from the current 10% of the NHS budget. A little bit authoritarian maybe, but nudges don't seem to work here. There are indirect costs to the economy too of things like type 2 diabetes. Now, Big Food is a notoriously powerful lobby, and I'd wish the very best of luck to those who already tried to tackle it. Jamie Oliver, Dr. Chris Van Tulloken, there are plenty more. Anyway, after that slight drift away to the end of my political career before it's even started, without consumption growth and without much government spending growth, we find ourselves on the shorter end. Or the fact that consumption has dropped so much means it can and will come back, and there will be some growth there. Not until the cost of debt has been absorbed directly or indirectly by households, however. Back to my 33% price increase in interest rates. When will that come? Difficult to say, but as a proxy of when existing rates on mortgages match new rates is as good a proxy as any, as I'd suggest. So remember that 33% gap at the moment. But of course, that number of stock is coming up every month as lower rates drop off. And then hopefully the draw rate is coming down, or will start to come down. So it hasn't been coming down this year, but it will start to trend back downwards. And the two will meet perhaps at about 4.4, 4.3%, something like that maybe. Let's see how we go. Growth in spending is needed, of course, as the population grows on the health service, although we're growing around the 1% level at the moment, or have in the past couple of years, mostly due to much higher net migration figures. This is the only way our real GDP has actually really grown, with a meaningful increase in people papering over the cracks of a previously dropping GDP per capita. So the moral of the story, government spending can't carry on increasing above the growth rate without raising taxes more. It's just basic and simple mathematics, I'm afraid. Income taxes are down significantly for the median earner since 2010, but we all know that the tax burden is much higher overall. And when the tax burden is higher, people are paying that tax one way, directly, indirectly, whatever. So income taxes might be down, but we know the tax burden is higher. And we know that the blend will continue to change with further tinkering, new administrations, and all the rest of it. So listen, how about the property implications of all of this? If we look at the classic household tenures in 2022-23, the last full year for which we've got the statistics at the governmental level, 358,000 of 15.8 million owner-occupier households moved within the sector. 2.26% of people moved from one house to another, that's all, in 2.26% of owner-occupiers. Anyway, 109,000 sold and moved into private rental. 211,000 private renters became homeowners. So that's a net loss of 102,000 privately rented households to the owner-occupier sector. 192,000 new households became private renters, however. So on a rolling basis, 90,000 new private rented households. A net 22,000 went into the social housing sector. 60,000 left, 38,000 joined the PRS from the social sector. 676,000 households moved in that year within that sector, 14.7% of households. So that all adds up to 20.6% leaving the sector, or an implied average tenure length of 4.85 years in the PRS. However, across all tenures, there were 301,000 new households. That's a growth of 1.23%, above population growth, and likely to continue for some time as we have a fair lump in our population pyramid of those most likely to move to a new dwelling. This is those who come of age and move out of home in the coming decade. What's the point of all this? Well, firstly, it answers a question regarding the private rental sector and first-time buyers. Of new owner-occupiers, 102,000 net were from the PRS. Minus 1,000 were from the social rented sector, and 77,000 were just brand new households. So they either came to the UK and bought property, or they moved from mum and dad's or somewhere else straight into an owned property, largely. So they didn't come from one of the other two sectors. So 57% of those new buyers came from rental. Secondly, it tells us how many new rental units we need each year. Although with somewhat lower immigration numbers, it would not be so dramatic. And the legal migration numbers are falling. But for 22-23, that answer would have been 68,000 new rental units, just in that year. The government suggests that 35,000 new rental dwellings were delivered in that year. Most other data sources do disagree, but there you go. That leaves a shortage of 33,000 rental units. So, now that's just on the new households in the sector, bear in mind beyond the shortage there already was. Social housing was not far off the same number, 32,000 new households, 1,000 absorbed from former owner-occupier to social, and 22,000 net from the PRS, 55,000 new units required. Owner-occupier wise, 178,000 new units would have been needed. That takes you to 301,000 new households created in that year. And obviously the stock has come from somewhere. But we know that 234,400 net new units were created. The government figures say 176,000 dwellings went into the owner-occupier sector, so only a 2,000 shortage of new stock. 23,000 more buildings were vacant than the year before, and 12,300 more buildings were long-term vacant than a year before. So that's another 23,000 shortage. It's quite hard to cobble all these figures together from multiple sources, and many sources disagree fairly strongly with each other. But it appears that around about 40,700 new social rent units were delivered in this same year, and 15,800 disappeared by Right to Buy and its associated schemes. That net 25,000 units leaves a shortage of around 30,000 just from that year. The government even disagrees with themselves on their reported statistics, but to an extent I do sympathise, because we know that the rental data is pretty weak overall. It's hard to see the truth, but the shortage, all of it in truth, does look to be concentrated in the rental sector if we trust the best guess figures. If there was more stock delivered, it would be likely to be bought, you would think. Or you can't buy what isn't there. We also know that we likely have a bad number coming for the 23-24 financial year due to starts being down 16% at the last currently reported point. That was the 31st of December 23, so we've only got one quarter left. Obviously that quarter's already happened, but I mean as far as the figures are concerned, we've only got one quarter left, and we should see these figures later this month. NHBC registrations were down 20% in Q1 24 compared to Q1 23, but then population growth also would have eased, so it's tough to see at this point whether we, the nation as a whole, would have been better off or not. However, what's clear is that the PRS have the largest shortage in real time, even if you do think it grew in 2022-23, closely followed by the social sector. We know from last week's supplement where the Labour Party want to focus their attention, social housing. And we also know in the absence of manifestos, instead we spent the week talking about Diane Abbott, Partygate and other things that neither of the frontrunners really want to talk about. So where does that leave us? Largely where we were after last week's rant regarding that ridiculously partisan report, which isn't going to help to solve the housing problems in the UK. This is from a very different angle and also has a slightly more nuanced conclusion. The future seems to hold a relatively muted private rented sector, thanks to policy, mostly, and investment case, strengthening fairly rapidly, but damaged by the new/old interest rate environment. Socials actually moved forwards, but not quickly enough. The damage was mostly done in the early 1980s in the halcyon days of Right to Buy, but has never been fixed thus far. Taxes look set to continue to be high as we listen to growth, and other tropes with a lack of believable plan. In the defence of Labour, or in an attempt to remain neutral, Wes Streeting, to his credit, has said a number of times we need to reform the NHS or lose it. The saying used to be, to the victors go the spoils, but it seems more apt in the damp squib theme to say something more like to the survivors will go the spoils. We've got 6 months more treacle at least before we know where we are, or a year at least before leasehold reform is made more clear. The detail is filled in after the law has been passed. Since COVID, so much seems to be manana, we should be used to it by now, I suppose. So well done for staying with it till the end, and remember those early bird tickets for the next property business workshop on Thursday 4th of July, bit.ly/PBW3. And there's only one way we can deal with all this continual noise and election claptrap, of course. Keep calm, always read or listen to the supplement, and carry on. Thank you.